Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. It's Wednesday, January 21st, 2026. Today we're following the bond market, because where the 10-year Treasury goes, CRE follows. So let's jump right into what's hot. And topping our list is Treasury stability. The 10-year Treasury yield sits at 4.29% today, down just slightly from yesterday. Now, after the volatility we all endured in late 2024, seeing the Treasury settle into that 4% to 4.3% range is exactly what CRE investors have been waiting for. This stability is the green light the market needed, and we're already seeing the effects. Our next hot item: deal volume is returning. CRE investment activity is projected to increase a healthy 16% in 2026, potentially reaching $562 billion. To put that in perspective, that's nearly matching pre-pandemic levels. The bond market stabilization is what's unlocking this transaction flow. Buyers and sellers can finally underwrite deals with confidence again. This leads directly to our third point. Cap rate compression is ahead. With Treasury yields finding their footing, cap rates across most property types are expected to compress 5 to 15 basis points. We see industrial and Class B multifamily leading the way. That frustratingly wide bid-ask spread that stalled the market, it's finally narrowing. And finally, the multifamily debt markets are robust. Lenders are back. The debt markets for multifamily remain strong heading into 2026, with senior loans yielding 8 to 10%. For debt funds, that's providing some very attractive risk-adjusted returns. Now for the flip side, what's not so hot. First up is Fed uncertainty. If you're expecting aggressive rate cuts, you might want to temper those expectations. JP Morgan now expects the Fed to remain on hold through all of 2026, keeping the funds rate parked at 3.5 to 3.75%. Goldman Sachs is slightly more optimistic, forecasting cuts in March and June pushing to 3 to 3.25%. But the Fed's own dot plot suggests just one 25 basis point cut this year. Not a lot of movement, and the reason for that caution? Inflation is still sticky. The annualized inflation rate sits at 2.7%, and that's still above the Fed's 2% target. The Fed doesn't expect to hit that target until 2028. So, higher for longer isn't just a buzzword. It's the reality. The other major headwind is rising construction costs. High interest rates and stubbornly high construction costs are squeezing developer margins. This means project viability is challenged, and new supply will almost certainly remain constrained. So, why does all of this matter? The 10-year Treasury is the benchmark for CRE, period. At 4.29%, we're in a zone that works. It's not great, but it's workable. The key insight is this: stability matters more than the absolute level. When the 10-year bounces wildly between 3.8% and 4.5%, nobody can underwrite. But when it sits steady around 4.2 to 4.3%, deals get done. The Fed funds rate gets all the headlines, but long-term rates are what drive this industry. A stable 10-year in the 4.0 to 4.25% range with inflation around 3% is a supportive environment for commercial real estate. We're very close to that sweet spot. The wild card to watch? Jerome Powell's term expires May 15th, and a new Fed chair selection could definitely introduce volatility. So, keep an eye on that. So, what's your investor takeaway? Treasury stability at 4.29% is bullish for deal flow. Expect that cap rate compression of 5 to 15 basis points, but don't count on aggressive Fed cuts. Higher for longer is the base case. The smart money will focus on income-producing assets that work at current rates. The transaction market is thawing, so be ready to move. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.